but that's kind of the state of play here in the world of crypto. Like, millions of dollars are pocket change. Don't talk to me, don't cry until we're in the area of tens of millions of dollars. But that is what's going on with the gigantic decentralized finance protocol Aave right now, as members of the community lash out at Aave Labs, the main company that manages the Aave protocol, because it's learned that Aave Labs has started to hold on to the profit it earns off of the front end they offer for people who want to use Aave through the Aave website. It has been a spicy little fight this week, and one that has led me to think it might be worth just sort of zooming back out and refreshing my memory and all of our memory about just what Aave is, because it is, after all, the biggest thing in this sector of cryptocurrency, which is probably one of the most important, and that is decentralized finance. So before I do that, let me just say hello and welcome to the second episode of Diamond Rhino. My name is Brady Dale. This podcast is part of Front Stage Exit, the newsletter that I run on Substack. If you haven't heard me before, I've been a longtime crypto reporter. I worked at CoinDesk in 2017, then I was at the Defiant for about a year, and then I moved to Axios, where I reported on cryptocurrency for the mainstream media for almost 4 years. And I left recently to start Front Stage Exit. So this podcast, Diamond Rhino, is part of that effort, and hopefully it'll come out roughly every week. And usually it's going to be some kind of deep dive into an important category of cryptocurrency, but sometimes it'll be a little something else. But for today, we are definitely talking about crypto. We're talking about decentralized finance. We're talking about Aave. Aave launched in 2020, though that's not really true. It pivoted out of ETH Lend, which was around from like 2016 or 2017, launched with an ICO. The Lend token was peer-to-peer lending. It broke $10 billion in 2021. So far, its peak has been $45 billion this last October. So it's doing really well. It's been a very creative project. It's made its own stablecoin, Go. It was eager to go multi-chain. I think it's on 10 different chains now. It brought out flash loans nearly from the very beginning, in the first few months of it existing. And of course, the Aave Labs team launched Lens, the social media network. And there's been other recent things later we'll talk about later. Mark Zeller was once a part of the Aave Labs team. Now he's a member of the DAO who independently participates in the broader ecosystem. And he had this to say on the podcast Bell Curve about Aave last year.
And it's proven by data that people are ready to pay to use Aave, and they are okay with the fees. And because the fee created a self-sustainable economy of the protocol can pay all its own bills. And that's the main thing, is that we are one of the only DAO on Earth with MakerDAO, which is one of the notable exceptions that are cash flow positive.
But like we said at the start of this episode, we talked about how there is a fight going on over revenue on this front end for a project that has literally billions of dollars under management. Why is this a DeFi protocol that people are willing to fight over? We're going to get into that and more on the rest of this episode. But first, let's talk more about what Aave fundamentally is and how it works, why it matters. There was Aave, there was ETHLend. And ETHLend was a platform for people to deposit funds and then to lend them out to other people. And it was sort of a peer-to-peer marketplace for people to do that. They created the Lend token, which was sold in 2017. $16 million worth of that was sold in the ICO. And that sort of kicked off the project that would ultimately become Aave. But what would inspire Aave was in 2018, Robert Leshner would launch Compound. And Compound was the first money market in the DeFi space that offered pooled liquidity. So it would put a bunch of tokens together into a pot, and you could earn interest off of those tokens, and then you could also borrow other tokens that came out of it. And I wrote about Compound when it first came out, but what I loved is how everyone else who wrote about it, particularly TechCrunch, I remember TechCrunch writing about it. Why would you want to deposit money and then borrow money. Like, what did you need to borrow money if you had money? The way it was pitched at the start, though, was a way to short cryptocurrencies, right? Because back in 2018, everyone thought this whole market was going to fall apart. There was no reason for people to be here. So the way Leshner would tell people about it is like, well, if you don't think that 0x is a good investment, you could deposit ETH, borrow a bunch of 0x, sell it, and then when it falls in value, you could buy back the amount that you needed at a lower price. You get to pocket the difference, and then you're able to repay your 0x loan and draw your ETH back out, and so you've made a profit, right? So that's how people talked about it. Which, of course, like we've learned since then, the main reason why people do this is because they want to trade, right? And they want to hold on to their long conviction in something. So you like maybe, for example, you love ETH, you have ETH, you deposit the ETH, and then you borrow something else against that you have some sort of trading opinion about. Usually people just borrow a stable coin because you can trade whatever, but maybe you think in the near term some other token is going to go up. At the time, I remember 0x was one of the first tokens that was approved in Compound. So you might think that 0x was going to have some positive news coming soon. So you deposit your ETH, you borrow 0x, you sit on it, it goes up in value, and then you sell it and you buy more ETH, so, and then you can withdraw your ETH and you've made a profit and you have more ETH than you used to have. But the crucial thing there is that Compound was offering this pool of funds. It was putting them all into the same pot. You could deposit into it and just earn yield, or you could also borrow something that somebody else had deposited in there. And everyone earned and was paid the same rates in those things. It was just determined by the market. They had an algorithm in there that just said, this many people, the more people asked for a given cryptocurrency, the more they were paying people in yield for depositing it, and vice versa. So that was Compound. The thing that really was crazy to me about the early days of DeFi lending was this whole idea that you could go on chain with nothing but a cryptocurrency wallet. In theory, you're just a string of numbers to the blockchain, and you could have some money in there, and you could go into one of these DeFi protocols and take out a loan. I did that one day. It was, for me, it was like one of the great moments for me, like sort of starting to understand this space. I went in to Compound, and I think I deposited like $100 worth of ETH. And then I borrowed like 2/3 of that, or like half of it, in some sort of stable coin. And I didn't need it for anything. I just did it to do it. And I was just looking there at the internet, and I was like, I just took out a loan. And like, it happened in a second, and no one knew what my name was, and I didn't have to fill out any forms. I mean, that's so crazy. That was so crazy. I always tell people, if you've never messed around with DeFi, it really is enlightening to just do a few things, to like take out a little bit of loan and then just quickly repay it, but just see how easily it works. It's kind of mind blowing. So in 2020, they pivoted ETHLend to Aave. And I sort of remember this happening. I have always had a bit of a prejudice against rebrands, and so I didn't pay a lot of attention to it because I just hate it when companies change their names. I just think it's dumb PR shenanigans. A lot of times it's just chasing a headline. But what I didn't understand at the time, because all this was so new, is that Aave, it did justify that they changed their name, because they were fundamentally changing course. They went from this sort of peer-to-peer lending marketplace to this pooled liquidity approach, which is, it's a sea change. And so they went from being ETHLend, a very a very of that era sort of name, to something broader, something bigger and vaguer, and that was Aave. And if you haven't heard before, Aave means ghost in Finnish. Stanley Kuleshov, the founder of Aave and the face of Aave, is a Finnish man, and so he's the one who came up with that. And so so with Aave, just like with Compound, what you could do is you could deposit funds, and you could just earn yield on it and just leave it there if that's what you wanted, but you could also borrow if you had some move you wanted to make in the market. I mean, some people borrowed and did real things by like bought cars or whatever, but that was rare. Mostly people were borrowing because they had some sort of trading they wanted to do. And so they had a pool of all these funds pooled together, and Stanley described it well back in the day when he had one of his earliest conversations on the Epicenter podcast in 2020, in the earliest days of Aave.
We noticed that the pooled model, now that we have stablecoins on the ecosystem, and there was successful pooled models, for example, Uniswap, Compound, we basically turned ETHLend into Aave, which meant going from order matching lending and borrowing into pooled model, where you can grab the liquidity instantly as a borrower, and you can just deposit as a lender and start earning, which is very powerful. But it was pretty much the idea of the compound model, and that was particularly the DeFi narrative at that point. And we wanted to expand the narrative and trying to think like how we bootstrap more liquidity, because end of the day, the whole Web 3.0 network effect is liquidity. So you get liquidity when you know how to yield hack. So the thing that people are doing now is yield hacking, how you get more yield from your protocol. And that's why we see things like iEarn curve, where people are trying to get more APR and APIs and more yield.
People could deposit different assets on Aave, and those assets would earn different rates. You know what people pretty quickly learned is that most folks who deposited things, they wanted to borrow stablecoins. Stablecoins became the most important thing to offer for lending, so a lot of times they also earned the best rates for depositing. But yeah, you know, if you wanted to make trades, maybe you wanted to make multiple trades, the easiest thing was to just you could just withdraw stablecoins and make all the trades you wanted, because stablecoins are very liquid and there's pairs and everything. So they started to do that. And this was a fun era too, because this is the time when iEarn, which later becomes Yearn, comes along. This guy Andre Cronje, who's this kind of visionary DeFi programmer. He has this very artistic personality. He gets very intense, but he created this thing called iEarn, because back in those days there were all these DeFi projects coming out, and they all had different kinds of yields on them. And because they were all sort of yields defined by the market, and because they sort of had different functions, and the market was fairly fragmented and no one really knew what they were doing, you know, you might have a great earn on some stablecoin in one place one day, and it could change by a few points in another place the other day. And so Andre made his own DeFi application that just kind of, I have no idea how it worked. It might have just been Andre doing it, but you could deposit anything you wanted, and it would look for that same thing on various DeFi apps and deposit into whichever one had the best yield. And of course, on some level, the bigger this thing got, the bigger impact it would have on the market. Because of course, if something wasn't paying great yield over here, it's because it didn't have enough of it. Well, once Earn came along, or iEarn came along and dumped a bunch of liquidity in there, then of course they had all that they needed and the yield would go down. So, but he was constantly working that out. He was constantly playing with it, and people were constantly yelling at them because this thing that he was doing for free and wasn't making any money off of, at least at first, was, you know, it was less than perfect at times. And on that Epicenter podcast, Stanley had some funny things to say about how much flack people were giving him.
There was like a lot of hysteria, and he wrote a blog post like, why building in DeFi sucks, because like you try to do everything, and then people expect that you're 24/7 customer service representative at the same time, and you're a developer and debugging everything. And we are building financial products. I mean, if you're pushing something out there, we need to understand that as well. But also it kind of shows that how much we have to grow as a people.
When I look back on that time, which was moving into what we would eventually call DeFi summer, I was paying much less attention to Aave, and I was paying a lot more attention to Compound, because Robert Leshner had been the first person to sort of explain DeFi to me and to make it make sense, and he was a good source to me. And so, you know, and he had this whole story that he told, which I think was right, that Compound was much more careful about what it offered to the market. So they only offered a small handful of cryptocurrencies for lending and for depositing. They were very careful about the ones they chose. Of course, ETH was in there. The most important thing was like ETH, Tether, and USDC. And so, but because, you know, I kind of believed this line, and I think it was right, that Compound was being careful, to me, you know, Aave was constantly adding new assets. They were listing new assets that they would take for deposits, and they would lend all the time. And it just seemed like they were changing willy-nilly, and so I wasn't paying too much attention to them. But it is wild, like how quickly they were moving and how fast they were innovating. You know, that first podcast that Stanny was on, and also Mark Zeller, who was, like I said, was at that time on the Aave Labs team, they talk about sort of how many directions the company was going, and at a certain point, Zeller stopped and reminded everybody of just how new all this is.
The very cool sign that this is happening is that we have to remind ourselves that the protocol is live for 2 months. Only 2 months, we already have like several cool live projects right now on mainnet that you can use one click of a button that tells something about the developer community that we are part of.
In that first year of Aave, by that time, Compound was a year and a half old. Well, I was only a little over a year old when Aave first came out. Compound comes out like at the end of 2018, and then Aave's there in 2020. And in the middle of 2020, that's when Compound suddenly dropped its token, Comp, and Comp took the world by storm, as they say. It took the world of cryptocurrency. It took the world of all of us sitting at home in the first few months of the pandemic with nothing to do but stare at our computer screens. A lot of people played video games. A lot of people looked at porn. And some people tried to make money purely on the internet. And a lot of people found DeFi in those days. And people were doing these various, yield hacking efforts like I described with Andre Kanye. But then this new thing came along that was, I actually think Synthetics invented this, but I can't remember the whole story. They did something very similar ahead of time, but they didn't get a ton of attention for it. The place that really got attention for it was Compound. And Compound did this thing that came to be known as liquidity mining, though people didn't call it. I mean, it mostly got to be referred to as yield farming, sort of lumped it all together. But for this moment, bear with me, let me make the distinction of liquidity mining versus yield farming. So liquidity mining, it was called mining because you would get some new token. So you would provide liquidity for a thing. So what Comp did is they said, we have this new Comp token that's coming out. We are going to give it to the people who are borrowing and the people who are lending on our platform at a defined rate. And I remember it was a lot really early. For the first few months, it was like a ton. And then it sort of, the amount that came out degraded over time. It might still be emitting. I don't know. They lost a bunch a while back. We'll get into that in a little bit. But the idea was whether you were lending or whether you were borrowing, you were earning Comp. And so what people would do is they would deposit $10,000 worth of ETH and then borrow whatever that would be. That'd be like $60,000 worth of USDC. Take that USDC. So they would be earning on both the deposit and the borrow because they're doing both now. Then they would take that USDC, swap it for more ETH, dump the ETH back in. You could usually do about 3 to 5 turns that way. And they would just keep changing things depending on which one of the various assets in there was getting the best rate in Comp and also the best rate in returns. Remember, there was this one point in there for some reason 0x was getting like just ridiculous rates of return on there. It was absurd. And so the total value locked, the amount of money deposited in Compound just shot up out of control. The price of Comp, which I had some reason to believe should have been somewhere around $40, it shot up to like $300. It was an insane thing. And of course, because it was working and because Comp was getting attention, everybody started to imitate them. But Aave didn't really imitate them on that front, as I recall. And in my looking back, I can't find any evidence that they did. People would get access to the Aave token a different way, and we'll talk about that in a second. But so liquidity mining was when you would put liquidity in somewhere to get out some specific new token. So, for Compound and Comp, that was you would deposit or you would borrow or both, and you would earn Comp on both sides. But yield farming was where it also combined it with the actual yield. So you were still earning profits off of making deposits. And so there's people who would do much more complex math to find places where you would get the most you could, not only off of the new tokens coming out, but also off whatever yield it was offering. And those things were constantly changing. So that's that distinction. So this was a really active era for Compound. The numbers we're talking about in 2021 were, merely the hundreds of millions of dollars. Neither of these protocols would break $1 billion until 2021. The highest Compound would ever get would be in early 2021 and late 2021, where 2 times in there. They would get, between $10 and $12 billion in total value locked. But that next year in 2021, Aave would start marching ahead of it sort of for good. It would proceed on from $10 billion and go much higher while kind of leaving Compound in the dust. In 2021 through 2023, as Aave boomed, it quickly embraced the multi-chain future. That was a funny time. There's no need to say a ton about that, but there were all these new blockchains out there, some old blockchains too, most notably Avalanche, and this also one of the older ones that was doing this was Phantom. And there were others. I think Polygon did it. One of the things all of these chains had to offer because it wasn't really use cases exactly, was they had giant piles of treasuries of tokens, since, all of these chains started with an enormous amount of tokens from the very start. And they started to give those tokens to different protocols for coming over there. So they would make announcements. So just like Compound was like, if you borrowed money on our platform, we'll just give you new comp tokens. Avalanche would say things like, if you port your app over to us, we have X number of tokens we're going to release every day. Each new app that comes into our system will distribute a certain amount to them based on the total value lock that you're able to bring in. So this became a giant bonanza across all the blockchains. I think it started with Avalanche, and other blockchains were doing it, and Aave was quick to move in on I think basically every chain that offered these kinds of proceeds for their users, because it was an opportunity for their users. They had liquidity, they wanted it. And why not have Aave everywhere? So Aave was quick to embrace this multi-chain future, and this whole era of wild token rewards ran from like 2021 to 2023. And now we're talking about version 4 of Aave coming out. So there's already been Aave version 1, which is deprecated. Version 2, I think it's almost done. And version 3 is the one that's running at the moment. Aave has updated itself in various ways along the years. And now it's looking at version 4, which will give lenders more control over how much exposure they have to different collateral. So the big picture of all of this is that Aave fundamentally is a place for you to earn yield and to borrow money. I think the stat is that like 80% of the people who've ever used Aave have only ever deposited into it. That's all they've ever done. They just put money in there to take the yield. And a much smaller portion have ever withdrawn from it in order to take out a loan. But this is the core idea of what Aave is. So that's how it works when it's working. But we all know that DeFi is risky. And that year that I mentioned, 2020, when Aave started, it started right at the start of that year. The other thing that happened at the start of that year is Black Thursday, when not only all of DeFi, but really all of the global markets seized up when it became clear that COVID was really kicking in. And on that day, the granddaddy of decentralized finance, MakerDAO, had a giant liquidity event in which they ended up being at least a little bit insolvent. They were like $5 to $8 million short once it all got sorted out, because the market just moved so quickly. So what lesson did that teach Aave, this new pup on the street, as it came out of the gates right amidst the worst moment in the history of DeFi? So, March 2020, the entire market seizes up, the world falls apart, Bitcoin drops wildly, and so ETH and the entire rest of the cryptocurrency market does too. The place where I saw this hit the hardest, though it hit all over cryptocurrency, was on one of the protocols that I was paying the most attention to at that time, and that was MakerDAO. If you're not familiar with MakerDAO, MakerDAO is sometimes described as the central bank of DeFi. It certainly was then. And the crux of MakerDAO is it's like Aave and Compound in that it's a lending market, but it lends in a way that still seems kind of weird to me. What it does is you would deposit ETH, you would deposit Ether, the coin of the realm, on Ethereum, and then you would borrow DAI at a prescribed rate. Only the DAI didn't exist until you borrowed it. That's how DAI got minted. So it wasn't like they had a giant pool of DAI that was backed by real dollars out there. No, the DAI was backed by your collateral. It still kind of makes my head scratch when I think about it, though. That is kind of how real banking works. What happened on Black Thursday was basically the markets were falling really fast. A hacker saw an opportunity. He had some code ready, and he was able to liquidate a bunch of loans on MakerDAO that had fallen out of their collateralization position. And he was able to do it in a way that sort of tricked the protocol. And he didn't just get a deal liquidating them. He actually was able to liquidate them for free because the system screwed up. And so they were $5 to $10 million short. MakerDAO has its way of working with that. It's they do it with the Maker token. They just issue more tokens, sell them on the market. That's how they get money back to cover a shortfall. But it was a very weird moment. It was scary. It looked bad. People were mad at me about my reporting on the whole story. Aave comes out amidst all of that, and clearly it wants to learn some kind of lesson. So it wants to be safer than whatever happened with MakerDAO, or at least have some kind of approach that would allow it to mitigate those risks, because things can go bad very quickly in the world of cryptocurrency. Aave comes out with the safety module. The safety module was, according to Stanny, was inspired by the direction Ethereum was taking at that time as it was heading towards proof of stake, which is how it works now. Stanny described that on the Staking Rewards podcast in July of 2021.
The inspiration for the safety module comes actually from Ethereum, because in the sense that validators are actually validating transactions against their hash power. But for example, in future, you're using ETH as a kind of like a collateral, as a stake to validate transactions. So you're transferring the risk from the users of the network to the stakers. So this is the kind of system that has been inspired by the Aave safety module.
So the way the safety module worked basically is people could deposit Aave, the Aave token, into the safety module. They could also deposit this other token that related to Balancer. It's not really worth going into. This is weird. It was basically a derivative of Aave. So they could deposit Aave or this derivative of Aave into the safety module, and those funds would be viewed as a sort of insurance policy. But people were paid for putting their assets in there. So Aave had a giant pool of Aave that it hadn't distributed yet. Aave the token. Aave had a giant pool of Aave the token that it would give to people for putting funds into the safety module. And so they would say, this is our fixed commission. We're giving out, say, 300 Aave a day, and we'll just distribute it pro rata to everyone who has funds in the safety module. That's how it worked. And the idea was that if there was ever a shortfall on Aave, then the Aave in the safety module could be sold on the open market for whatever Aave needed to cover the difference. And then everyone in the safety module would be slashed somewhat, pro rata up to some limit. So Aave actually has never had to use its insurance policy, but it's always been there. And this idea of depositing the core token and receiving interest on it in the core token is one of the ways it's been able to distribute the Aave token. So this is noteworthy. The big way that the Aave token came out and got into people's hands is if you had Lend, the original token, then you got Aave in exchange for it. So that was where the first big RAF of Aave hit the market. But then in an ongoing way, they didn't incentivize people for doing open market operations on Aave, doing the borrowing and the lending like Comp did. They incentivized people for providing an insurance policy to the overall protocol. And of course, Aave has another backup insurance policy, sort of unstated, but everyone knows it's there. Aave makes profits as a protocol, and it has a treasury, a pretty substantial treasury. And so it also always has that money that it can lean on. But like I said, they've never had to use the safety module either. But if you want to sort of hear a description of how it works, Robin Schmidt, back when he was with Defiant News, used to do these sort of how-tos on using different protocols. And he described how to use the safety module back in the early days.
So we're going to enter the amount we'd like to stake and hit stake. And then on the right-hand side of the page, the app provides all sorts of information about how much Aave you have staked, the amount of Aave you will earn per month, and it will tell you about the cooldown period, which is 10 days. Now, this one's important. The cooldown period refers to the duration it takes for you to receive your staked Aave tokens after withdrawing them. And why is it not immediate, you ask? Well, the 10-day period acts as a kind of safety module, so the network isn't disrupted when a large amount of tokens are unstaked. Next, the APY is mentioned, and we also saw this on CoinGecko. And then finally, we've got the slashing. Now, stake slashing acts as a security mechanism for the protocol, and it occurs in the event of a shortfall, which is kind of what happened when MakerDAO saw tons of liquidity just exit the market, and they got into real trouble for that. So slashing is designed to mitigate that. So in this situation, you could lose a maximum of 30% of your staked tokens, which sounds horrible. but it doesn't really happen very often. Now, Aave stakers are taking a risk to protect the protocol and therefore rewarded with safety incentives. And the last thing you're thinking, of course, is when harvest. Well, you decide on that. Providing liquidity to Aave will reward you with STK Aave tokens, and this is basically their version of the LP tokens that you might have heard of in relation to yield farming on other protocols. And when withdrawing your STK Aave tokens, the STK, or the staked part, gets burned, and you receive Aave at the end of the cooldown period.
So Aave is actually headed into a new direction with safety now. They have a new module approach, and they're calling it Umbrella. So they're looking to deprecate the safety module, as we've known it up to this point, and move over to Umbrella. And the way Umbrella works is it's meant to have people actually stake the things that people actually deposit and borrow on Aave, rather than it being Aave itself that people are staking. And Mark Zeller described that on the Bell Curve podcast really well in 2024.
And the principle of Umbrella is to completely remove this system. So these old safety module become the legacy safety module, and it's going to be deprecated if the governance vote for it, and replace it with a new system where user, instead of staking Aave, they can stake directly the A tokens. So A token is the recept asset you get when you deposit liquidity into Aave. So if you deposit USDC, for example, in Aave, you will get a USDC directly back into your wallet. It's an IOU that allows you to withdraw liquidity from the main protocol pool. And if you agree to stake the recept asset, you lose three things. The first thing that you lose is your ability to be liquid. So when you have an A token, you can withdraw anytime from the Aave protocol. If you stake it, you agree to not being able to withdraw for the next 20 days because you will have what we call a cooldown period. The second thing that you forfeit is your ability to borrow. Because if you have a USDC, you have borrowing power in the protocol. But as I said earlier in the beginning of your discussion, 80% of our users never borrow. They deposit USDC because they want more USDC, and so they don't really care what they about their borrowing power. What they want is their ability to get some yield. The third thing they renounce by doing that is their ability to be protected, because they are being volunteer to protect the other guys. So their asset will be a line of defense to protect the protocol and the other user from that debt. So what happens is, if there's what we call a shortfall event, so the value of collateral drops sharply overnight, and the liquidator are not fast enough to liquidate the position and protect the end users. And when I say we, it's the DAO, and it's fully automated. So there's no human intervention with the umbrella system. We'll seize the AUSDC, the AA rate, wrap it, or whatever asset that is fit to do that in the safety module, and burn the debt with it. So that's a seize and burn, and it does not rely at all on secondary liquidity. And this system doesn't require any swaps or any kind of special liquidity. So if you have 10 million AUSDC in the safety module and 1 million debt, you do a 10% haircut to every AUSDC stakers, and that's it.
One thing I want to point out about why I think this is a good move on the Aave community's part, and notably, this still hasn't happened. It takes a while for big changes like this to happen in protocols. The community has basically approved it in concept, but the code hasn't come out yet. So a variety of votes need to occur before it all goes into place. But the vision is there. Because one of the things that we've learned about in DeFi in the last few years is that it's not usually a good idea for a protocol to make its fundamental token a point of weakness in the larger protocol. No, it shouldn't be something that you can manipulate. Like, I don't know what the hack would be, but this was a big problem for Mango Markets. Mango Markets was it was kind of like an Aave on Solana, or Aave or Compound on Solana. And one of the things Mango Markets did is it had a governance token called Mango, and Mango was also available for lending and borrowing on the Mango Markets protocol. And of course, that seems like it's a good idea because, you should dog food, you should give people a way to use your token on your own platform, right? But the problem is, because Mango is just a governance token, it wasn't traded very much. It didn't have very deep liquidity out there. This guy named Avi Eisenberg saw an opportunity. He just borrowed a bunch of Mango and made it go up in value, and then he deposited it. And with its inflated value, he borrowed a bunch of tokens and stablecoins that actually had real value. And then, when the market got back in line again, the value of Mango dropped dramatically. He, of course, wasn't able to repay his loan, but he didn't care. He had more assets than Mango would ever be worth in his pocket, and he was just like, you just hold on to that loan. I'm not going to worry about it. So he was able to manipulate the market to walk away with a ton of money because he was able to manipulate this fundamental token. And so, Aave moving on from making the Aave token crucial to what secures the network is probably a good idea. Like I said, I don't know what the hack is there, but there might be a hack, and it's much better to move on to making the assets in its insurance policy be assets that are widely used throughout the system. So the plan is to move to a bunch of stablecoins plus wrapped ETH. And so that is where they're headed. And for those who are really interested in this and how this works, I will include a link to a tweet in the show notes, which gives sort of a diagram. So we've dealt with how Aave protects itself, but I want to zoom out and just talk really big picture about the whole world of money markets on DeFi. So they all have this same thing in common. MakerDAO, Compound, Aave, Morpho now, they all have this notion of liquidations. And so you put in collateral into these different protocols. They have some rule about how much collateral you need to make a loan. A lot of times the standard is 150%. So if you want to borrow $100, you need to put in $150 worth of, say, ETH. And the rule is, if the value of your collateral drops below the minimum amount on the platform, then you can be liquidated. And that requires some other person, some third party, to see that the value of your collateral has gotten too low to trigger an effect on the smart contract. They need to pay a transaction fee to do it. And their reward for doing that is your loan will be closed out, your collateral will be sold. Now, you're below 150, but you're above 100%. So they can still sell it and close out your loan, and the protocol will be made whole. That's why it's protective. The person who triggers it will get a chunk of that. I think it used to be like 13% in general, most places. I'm not sure. But they get a payment for doing it. That's why they're incentivized to do it. And you get whatever's left over. So you still have whatever you borrowed. Your loan's closed. It's fine. But you did lose a little bit of your collateral. That's the way it works. And the thing I want to point out here is, so this is how they stay safe out there. This is what protects these protocols. One thing that is notable is, you might have remembered that around the FTX collapse, the last really big collapse we had, a lot of lenders in the crypto space were massively under collateralized. They had all kinds of trouble. But the thing to note about that is, those were all centralized lenders. So they were companies where you just sent them funds as collateral, and they would make whatever loans they wanted, but it wasn't on chain. It wasn't transparent. They didn't have clear rules around it. In fact, a lot of the problems they got into was because they were just looking for really risky loans that they could make more money on from companies that they thought, like Three Arrows Capital, were a sure bet, but it turned out they weren't a sure bet. And so that's what went wrong. But none of the DeFi lenders, especially not the big ones like, Compound and Aave and MakerDAO, none of them became under collateralized in this insane liquidity event. There were tons of liquidations, tons of loans got closed out, but the solvency of the overall protocol in all of these cases was fine, and they didn't come up short on either loan. So that's really powerful, and it speaks to the strength of decentralized finance in general. But of course, we're here to talk about Aave specifically. So that's what makes Aave safe. We dealt with that. Now let's talk about what makes Aave scary. Early days of Aave, it was crucial to Stanny and the team that they give people more ways to earn yield off of their deposits than just basic vanilla lending and borrowing. And one of the first opportunities they sought to do that in their very first year as a pooled liquidity platform was flash loans on Epicenter back in 2020.
Yeah, I think because like liquidity isn't like unlimited. It feels now in DeFi that there's enough funds everywhere, and there's a lot of kind of like people in Ethereum that have, I mean, are whales, and with flash loans now everyone is a whale.
So flash loans are one of the craziest things in decentralized finance. I mean, they're nuts. So on that, the idea of a flash loan is you can borrow as much money as you want from any flash loan provider. So Aave was one. There was another early one called BZX. And they had these giant pools of liquidity, and you could borrow as much of them as you wanted, but you could only borrow them for the length of one transaction. So you could write some complicated transaction that could do a number of different things through a variety of different protocols. And as long as that transaction ended with repaying the loan plus a fee in full, it would work. And if all of those moving parts didn't resolve correctly, the loan just wouldn't close. There was no risk for you, and there was no risk for the lending platform, because the lending platform, from its perspective, the way time works in a blockchain, on a blockchain, time works in chunks. You know, there aren't like continuous moments, there's discrete moments. And from the blockchain's perspective, every individual block of transactions is one moment of time. Like 30 things can happen in there, but it all kind of happens at once. So the order of the transactions does matter. But that is sort of how time works. And so from the perspective of a blockchain protocol, if money is taken out and then put back into the same transaction, it's like there was never any money moved in the first place. So that's kind of how flash loans work. It's like a weird magical thing. And early on, it was like people knew that folks wanted to do this, but they didn't really know what they'd use them for. The example that Stanny and Mark give on that Epicenter podcast is people wrote this flash loan smart contract that would enable you to shift collateral that you had for loans on different platforms. So if, for example, you had collateral in Aave, but Compound was offering a lower rate, there were flash loans that you could use that would like borrow money for you to close a loan and then deposit it and take money back out. I can't even picture it, but apparently people wrote these web portals that would just sort of do it all for you. That was an actual sort of productive and healthy use case for flash loans early on. Stanny sort of describes the early history of flash loans on that Epicenter podcast.
In Finland, we used to call this kind of like minute money, where you need to open a company and you have to put 2,500 euros on the account, but you just needed to do it for that particular visit to the bank account. And then once you have done it, you can return those funds to whatever you borrowed them. Now, in terms of the DeFi ecosystem, there was a couple of previous iterations of flash loans. And I think as a concept, it's not that like new because of the atomicity of Ethereum has been known from the very get-go. But I think what made them pretty popular is that we tried to do the flash loans to the developer community and into the different hackathons, and that's why we see people building things and getting a bit of network effect. And what end up happening is that people are looking, okay, here's a very cool thing, how I could actually use to make a lot of money, and then we saw the hacks.
Now, in terms of what flash loans are currently used for, I went looking around for people describing that for me. One thing that people who are really high-end traders can use them for is arbitraging between two dexes. So if you're fast enough and smart enough to spot that there is a dislocation in the market between two different decentralized exchanges, you can use flash loans to take advantage of that and to go bigger than you would be able to with the amount of money that you actually have. There's also ways to kind of go 2x long or 2x short on or whatever x, however many x's you want on some sort of movement that you think might happen in the market. And again, with flash loans, there's never any risk if you get it wrong, because if you don't get it right and it doesn't pay back correctly, that the loan just never happens. But of course, the thing that people really used flash loans for, and the reason they're scary, is because they were used for attacks on different decentralized finance platforms. And I remember some of these first attacks hitting CoinDesk. When they happened, we were all just baffled by this concept of a flash loan attack. I remember that Will Foxley, who's now running Blockspace Media, big Bitcoin reporting guy. In those days, he was like the other DeFi guy at CoinDesk with me. And I remember the flash loan thing happened, and our editors were just like, who can deal with this? And I was working on some of their story, and Will was like, I'll sort it out. And I was like, oh, thank God, that sounds so weird and complicated. And honestly, it's something that I think still sounds really weird and complicated. But Mark Zeller and Sani talked on this Epicenter podcast. There had already been one flash loan in the wild. They hadn't actually used Aave's flash loan mechanism to use it. They'd used someone else.
The first one was pretty straightforward. So basically, they took a flash loan in it and basically converted to, I think, WBTC, was it that way? And then they pushed the price down in the decentralized exchanges, which affected basically the price of Uniswap to plunge on WBTC. And at the same time, half of the funds that the attacker had, he basically took a leveraged position in BZX. So he basically broke a bit their oracle there and made money at the same time with the short position that was leveraged. That was pretty much about it. So the kind of challenge is that in BZX, they took the prices from decentralized exchanges.
Flash loans continue to plague DeFi. They are still a big problem. In recent days, this project called Bunny was completely shut down after an $8 million flash loan attack against it in December. And there was a $100 million hack against Balancer, which is sort of an index maker. That happened in the fall, and that blew everyone's mind because that was very old code. Balancers basically thought of it as a blue chip at this point, but it got busted for $100 million because of some old mistake that someone found. So people use flash loans to make trades and stuff like that. There are sort of normal and productive use cases about it, but they're scary and they're weird because unless you are a hardcore DeFi wizard, you never hear about flash loans unless something has blown up. That's the only way they make the news. Otherwise, they're not anything that any normal people ever talk about. But on the plus side, what flash loans show is that DeFi is opening up wild new primitives, wild new use cases, new things you could never do before. And Aave's strength seems to have been that it's leaning into this kind of innovative space. You have to feel weird about the fact that they're leaning into flash loans, though, since the only thing you ever hear about them is for crime. Aave still enables them, and other protocols do too, so apparently they must be useful in some other way. But yeah, they are this weird, new, powerful, interesting thing, but maybe on balance they're good? I don't know. I remember once upon a time, Warren Buffett said that financial derivatives were like rat poison squared, so he also said that about Bitcoin too, so the old man's been wrong at times. They are impressive, and they are like financial mysteries. One more thing that's worth saying about Aave and the Aave ecosystem right now, and this is one of the weird things about DeFi, is for a lot of these projects, there is the company that started the thing, and then there's the thing. So a lot of times the company that started the thing will be whatever labs, and that's true with Aave. You've got Aave Labs, and then there's Aave, the protocol. And over the years, there's now a number of other companies who are working on Aave, the protocol. Like BDG Labs, for example, is one I learned about researching this. I'm sure there's a few more that I don't know. But sometimes it gets confusing because you're talking about Aave Labs, the company that made Aave happen, but then Aave is a protocol that just exists on different blockchains and is run by holders of the Aave token, and that's a pretty decentralized network of people now. So just something to keep in mind. Sometimes there's the company behind Aave, and then sometimes there's Aave itself. So right now, where do we stand? What is the state of play? Well, like I said, Aave is the giant of the DeFi world, often the most dominant single app in DeFi. Currently, it's earning, according to DeFi Llama, an annualized return of $67 million. Its treasury currently sits at $153 million. Now, back in the early days of 2020 and 2021, there were a bunch of copies of Compound and of Aave. They were left, right, and center on other blockchains. The most notable one was probably Cream, which was CREAM, all capitalized, which was a direct reference to the song Cash Rules Everything Around Me. It was founded by a guy who actually used to be a rapper, and I'm not making that up. But the thing about Cream was, as fast as Aave moved, Cream moved even faster. They would basically integrate any token that you wanted to name, and that definitely caused a bunch of hacks, since tokens aren't really just tokens. A lot of them have like weird code elements to them, and that got a lot of those things broke on Cream, but they didn't really care. Then there was also Euler or Euler. I think you say it Euler. I never really know how to say that, but it's EULER. That was another early sort of innovative money market protocol. Their big thing is that you could deposit any asset and you could borrow any asset, and the market would just sort of work out the price for that. They had a giant hack in 2023. The whole thing fell apart. It's actually been coming back this year. I don't really know why. It's up to about like it got up to as high as $2 billion in total value locked, but I didn't sort out what changed there. It's down around $1 billion now, but it was another innovative DeFi protocol. But the one that I want to talk about here for a second, the other big competitor that's come along to Aave, and which is kind of probably at this point, I think it's fair to say, has replaced Compound as sort of the number 2 in the money market game, is Morpho. Morpho first came along in I think 2022. I think I have that right. And the initial idea of Morpho was it wanted to give people who were really particular about their returns a way to goose the system for slightly better returns overall. So the way it works, and this is kind of hard to picture, but if you deposited funds into Morpho, it would take your funds and redeposit them into whichever Compound or Aave was providing the best rates for whatever you were depositing at that time. If somebody came to Morpho and said, I want to borrow something, then Morpho would withdraw that something from wherever it had deposited it, and they would offer it to the person who wanted to borrow at slightly lower rates than whatever Compound or Aave were offering for borrowing, but also give the person who was lending it, the person who'd supplied the liquidity, a slightly better rate than they would get their deposit on Compound and Aave. So basically, if there was like a 3% difference between the borrow rate and the yield rate, so like if you could deposit USDT and earn 2%, but you borrowed it at 5%, then what Morpho would do is you would just get the 2% until someone came along and wanted to borrow it, and then they would give you, say, 2.5% yield and give that person who wanted to borrow a 4% interest rate, right? And so that person gets a slightly lower interest rate, you get a slightly better yield. Theoretically, everybody wins. Now, when I heard about this, I kind of thought it was a vampire protocol, right? Because it's sort of, yes, it's providing liquidity to these protocols, but it's also doing it in order to attract people to take loans out elsewhere and sort of steal from the lending market and sort of pull this bait and switch on these folks who sort of had created this whole marketplace in the first place. So I don't know. When I brought that up with the guy who created Morpho back in the day, Paul Frambot, I remember he strongly pushed back against it, but it's always had a weird vibe to me, but it's worked out. It's been very popular. People like Morpho. A lot of people have used it. Morpho started to compete directly with Aave in 2024. They are now just a full-on money market. Their deposits are up to about $6 billion now. And at that time, right around that same time, Gauntlet, which is this really important risk managing company in the whole DeFi space, they get hired by lots of different protocols to help them think of how to think about the risk in the system, how to price things correctly. It's all these sort of like math wizards who work there. Tarun Chitra, who you might know, he's sort of the most famous person out of Gauntlet. He's on the Chopping Block podcast. But John Morrow is his co-founder with him, and for whatever reason, they had been working with Aave for several years in 2024, and they decided to leave that year. There was a story in DL News about it where they said it was just kind of a mismatch between expectations between the two. I don't know, sounds like drama, but they left and went to Morpho and have been working with them ever since then. Last year on the Wallfacer Labs podcast, Murrow just sort of like stepped back and looked a big picture at competition in the money market space.
I think it's really exciting how much competition there is, not only participating in these markets as a curator, but also as a user. And I'm doing stuff like borrowing on Aave because rates are lower there, and carry trade over to Euler or Morpho and things like that. So I think there are going to be winners. Like I think Aave is doing really, really well. and I'm happy for all the success. So I think at that size, like they're able to support certain trades at a larger capacity that you couldn't do in other protocols. So they're going to have some basically advantages there just because of the size they've accumulated. So there could be some almost sort of network effects there in that they built out, a network of borrowers and lenders that is more robust than other protocols. And hey, they've had quite a bit of a head start over most of them. However, you see innovation like Morpho and Euler that are exploring different models and models that I think in many ways allowed them to create better capital efficiency and better outcomes, especially for lenders in the short term. But yeah, I think Aave always has this thing. They're like, just use Aave. And I'm like, okay, great. But you should look at your other options because you're leaving a ton of money on the table if you don't look.
Yeah, so that is just the money market piece. But the Aave Labs team hasn't stopped at money markets. They also moved into social media, crazily enough. And when Stanny was on that Staking Rewards podcast back in 2022, they brought that up, and the host of it was like, "Were you guys serious that you want to put Twitter onto the blockchain?"
Yeah, I mean, we never joke. I mean, everything we usually talk about, we want to explore and also kind of like build. The Aave team and the idea of Aave is that we're kind of like a Web3 builder. We want to build things that are related to Web3, and they don't need to be necessarily related to DeFi. It can be NFT protocols, social media protocols.
So I actually remember when the Lens era happened. I was working at the Defiant then. Cami Russo, the founder of the Defiant, is extremely well connected among all of the founders in the DeFi space. She's sort of seen as not just a reporter, but kind of like an innovator in the space herself. And so she was on Stanny's list when he decided to sort of soft announce that he was doing this. And so we had a scoop. We were the first to report about it at the Defiant, that Aave was kicking around the idea of some kind of social network. And then a month later, in February of 2022, word came out they were creating this thing called Lens. And Lens was meant to be a bottom layer for the social graph that other people could come along and build apps on, and you could own your content. I am going to be honest, I thought it came out of nowhere. Like the host of the Staking Rewards show, I was like, why are you guys doing this? You're a bank. You're not Twitter. And honestly, I never really heard anything about it. In recent days, because I'm doing Front Stage Exit so intensely, I've gotten a lot more active on social media as I try to reignite whatever network I had on there before. And one person I stumbled on was this woman who goes by @JessieFry on Twitter. And her whole shtick is she talks about how much she loves fries, and she's been involved in different kinds of crypto social media and is involved in different cryptocurrencies. But one of the things she posted recently is she kind of hit a milestone on Twitter. She gets to be monetized now, and she said that her sort of path into social media started on Lens, and it was small and it felt comfortable, and she sort of figured out what she wanted to say on there and sort of found her identity. And I just thought it was striking because I was like, I've literally never heard anyone talk about using Lens before. This sort of speaks to a thing at Aave Labs where it's a company that likes to change even though change is risky. And that's something that Ernesto Boado of BGD Labs talked about at the DeFi Security Summit last year.
We believe pretty hardly like that all the systems should evolve because it's quite natural. So the idea of pure immutability is is nice, but even like on the base layer, like let's say Ethereum, things change over time. That is one of the strengths we think of the Ethereum community. So on Aave we try to kind of reproduce the same, but like on the smart contracts layer. So at the same time, obviously, whenever you add new features, or any type of change, the attack surface on a protocol, on DeFi protocol like Aave, it increases. So the more you add, the more potential issues.
So now Aave is in the middle of another large change. We talked about the umbrella security model earlier. There's more to it than that, though. They are also heading into creating version 4. So version 4 is being built right now. And the crucial thing about version 4 is it's this hub and smoke model. So the idea is people can deposit all these different kinds of cryptocurrencies into one big pool. But in version 4, they're now separating out the lending and the borrowing. They were all built into one big smart contract, and now they're splitting them into two different pieces. And so they can tinker on the borrow side and they can tinker on the lending side, and they can make them both more modular. And the crucial thing is for people who want to provide liquidity out there, They can now say that if we are, if I'm putting a giant pile of Tether into Aave for people to borrow, I can write my own terms in V4 for the kind of collateral that people can borrow against. So I can say, for example, if you want to borrow, let's just use the 0x token again. If you want to borrow against the 0x token, that looks like a highly volatile asset to me. And so this is the kind of payment I expect. This is sort of interest rate that I expect for taking the risk of lending against a low liquidity token like 0x. And you could also just say there's no rate at which I'll accept lending. So it allows people to, the current system with Aave v3 is, like I said, it's just the market determined. Everyone gets the same deal. As funds go in and out, the interest rates change, but they change for everyone. This allows people to say, like, if you want to borrow against this weird asset, I am only going to accept it at a certain APR. And that could be higher than anyone in the market will accept. And so you just won't make loans against that asset, but allows the market to sort of like segment itself based on the risk that they're able to permit. And Emilio Frangelo, who's currently still with Aave Labs and is working on this project, also described that pretty well at the DeFi Security Summit.
One pretty clear feature that we are missing at the moment is that we are basically unable to price risk efficiently. So one of the main problems with Aave v3 is that we do have quite strict risk management, but the only thing that you can manage there is actually risk exposure. So you can say how much you want to be exposed to a certain asset, but that's actually not enough, because you should be able also to say how much a certain asset should pay for that risk that the protocol is being exposed to, right? So for a collateral, it's not enough to be activated as collateral and to have certain caps that limit exposure, but it should also be possible to say that a certain collateral that brings a different risk profile should be paying a different amount for the liquidity that is provided against that collateral, right?
What V4 reminds me of for Aave is Uniswap v3. So if you're not familiar with that, in Uniswap v3, it allowed people who were supplying liquidity to the protocol to decide sort of which bands they were willing to trade in. So, it used to be that the early days of Uniswap, if you deposited funds into a pool, your funds were used at whatever prices that pool ended up at. So if there was a big price shock in an asset and you ended up selling a token that you had put in there really cheap, well, that was the risk of being involved in Uniswap. But in Uniswap v3, you can say, like, look, I am willing to supply a giant pile of Tether, but my Tether cannot be traded at any less than 99 cents or any more than $1. That is the band that my Tether can be used in. So it allowed people to much more precisely manage their risks. And I feel like that is a lot of what Aave is bringing in with V4 here. The other big thing that Aave has announced this year is they have this program that's coming called Horizon. And Horizon is a product that they're offering to institutional borrowers where they can come with real world assets, stocks, bonds, whatever. They can deposit those in Aave and they can borrow stablecoins. They get access to that stablecoin liquidity easily. They can do it in a compliant way. They can do it in a way that makes regulators happy. So this is Aave really moving into the big boy space. And so I don't think this is actually off the ground yet. If it is, I don't know what the numbers are, but it is an interesting new direction that Aave is going, and this has always been the plan. How do they get massive amounts of money on chain? And that's something that Stanny spoke about this year when he was at the ETHCC conference.
Finance being digital in the past decades means that everyone has access to that information, can read that access, and can actually trade across globally. Now the finance is moving on chain, which at the same time means that you have a new type of substrate, a new medium that has new types of properties. And those properties are about creating something that is more resilient, less single point of failures, more transparent, and more auditable.
There has been a lot of evolution in the DeFi space, but through all that evolution, Aave has largely stayed either on top or very close to the top. And it has been the defining kingmaker in money markets for a long time now. Like Murrow said, just use Aave has always been their motto. But one of the things I think the lens failure speaks to is Aave's willingness to take risks in terms of product, not just financial risks, but in terms of product. Case in point, in 2021, Compound, which is always Aave's big competitor, got hit with this bug where a massive amount of its treasury of Comp, the governance token, got distributed out to tons and tons of people. $80 million just sort of like went to the wind and they were never able to get it back. And that sort of shattered confidence in Compound, it seems like. I mean, the protocol is still going, people are still using it, it still operates, but it never really got its mojo back after that. And in fact, you could see, like I said, in the early days, what sort of seemed to make Compound stand out was it was always the careful one. It was the super thoughtful one. It was proceeding in a deliberate fashion. And that was an advantage at first, but it seems like it ultimately ended up being something of a liability. Aave didn't go too far too fast, but it was constantly evolving. And in fact, one thing that sort of speaks to all of that is when Compound v3 came along, it didn't offer more features or more products. It actually made the project simpler. In Compound v3, you could deposit a number of things to borrow against them, but you could only borrow one thing, and that was Circle's USDC. Why borrow anything but stablecoins since they're easy to trade for anything else? So just keep it simple, and then everyone knows what the liquidity going out is. But it seemed like the market wanted some more complexity. They wanted some more flexibility. They wanted to go straight into certain tokens. I don't know, but that has not worked to bring people around to Compound. Instead, it seems like Aave's willingness to take lots of swings, including misses like Lynn's, which was way out of its lane, and everyone knows social media is bad, but the willingness to take those risks kind of seems to have been somewhat difference maker for Aave. So it's good to stay safe out there, but I guess the lesson here is not too safe. So, as we come to a close here in our discussion, we get ready to revisit some of the topics from the beginning. I think it's worthwhile to hear from the creator of Aave and kind of where his mind is at on DeFi going forward.
This architecture allows to innovate new types of borrow configurations and reducing and segregating the risk, while at the same time all these different borrow configurations and customizations have the same access to the liquidity. So the liquidity becomes accessible to any innovation that will happen in the future within the Aave ecosystem. And also thinking from the interest rate perspective, instead of having one rate for all, how do we actually create interest rate markets within the Aave protocol that are subject to actually how much risk you're bringing into the protocol?
And so, the reason you're all hearing about Aave right now is because there's a fight between Aave Labs and Aave, the DAO, over the revenue on this front end. Because obviously the front end is very important. If people have heard about Aave, if they want to try it out, they want to go look for an easy way to get into it, most people are just going to go to the Aave website and they're going to use that to make whatever moves they want to make. And so that puts Aave Labs, which controls that website, in a pole position because, of course, they can charge a little bit of a fee for using that website and they can make some easy money there. Now, because this is a decentralized protocol, anyone who wants to, they can come along and make their own new website that creates their own access to Aave. People can make front ends left, right, and center. And to me, I don't really see what the big deal about somebody earning some profit off of a front end is. I think other similar situations have done it. I think Uniswap makes money off of its front end. I'm not sure, but I think I'm right about that. Pretty sure Tornado Cash, that's a complicated story, but I'm pretty sure they made a little money off their front end. So it almost seems to me like making some profit off the front end has been one of the ways in which these companies that make these amazing tools that kind of get given away to the world, I mean, not precisely given away, but sort of, in a way they're able to sort of monetize that work on some level. But folks don't exactly see it that way in the broader Aave community and in the broader DeFi community. I mean, one of the things I will say that I find a little frustrating in the crypto world is anytime somebody gets paid, folks seem to think they ought to have gotten a piece of it, whether or not their claim to that piece is right or not. And at the end of the day, we're just talking about, it's more money than I'll probably ever see, but it's just a few $1 million. According to DL News, the estimates for what Aave is earning these days off of the front end is something like $10 million a year. Apparently that amount went up a fair amount recently when it switched the way it did it over to a partnership with CowSwap. And by the way, I think it's very funny that I'm talking about $10 million out of something called CowSwap right now. But hey, that's the world of DeFi. I don't really know what CowSwap is or how it works. I probably should know that, but it just isn't something I've ever had to look into. I just hear CowSwap discussed from time to time, and I think it's kind of funny. It's just $10 million. I guess it's the principle of the thing, but at the end of the day, if the company that invented this whole thing is able to earn a few million off of running the website and continue to sort of support the larger project, maybe that's not that big of a deal. But like I said, I'm not in the middle of it. It clearly has unsettled or rattled Aave Labs somewhat. Stanny, the founder of Aave, dropped a big note on Twitter this week, sort of outlining his vision for Aave going into the future, saying the reasons why he believes Aave is going to win in the competition between different DeFi protocols and in the money market space. He noted to everyone that he dropped $10 million into Aave this week, sort of furthering his exposure to the marketplace that he created. And also this week, he dropped the news that the SEC had closed its investigation into Aave, and so Aave is no longer being persecuted by the U.S. authorities over whether or not it might be offering some kind of securities product, so that's also a big relief. Stanny is trying to get back on the side of the Aave community, and this controversy has rattled him somewhat. But look, here's what I see when I step back from all of this. What's powerful here is a bunch of weird nerds made this robot that runs on the internet and that somehow controls $50 billion nearly right now. And a bunch of different entities have a piece of it, have some kind of control over it. There's this massively decentralized shared stewardship of this thing. And people who no longer work for the company that created the thing but are still actively involved in the ecosystem have enough buy-in over this wild new financial product that they're willing to fight over it. I think that's kind of exciting and cool. The truth is, no one said it would be easy, and it's kind of encouraging that this space has come far enough that people believe that it's worthy to fight over and fight for. Thanks for being here with me this week on this latest edition of the Diamond Rhino. I probably won't have another edition next week because Christmas will probably screw me up, but I will certainly have one after that. Thank you for bearing with me on this. I am rapidly learning how to make these things and look forward to getting much, much better. I would love to hear your feedback on this episode. I promise you in the next few weeks, I'm going to do a very strange episode that's going to have absolutely nothing to do with decentralized finance, and I hope it doesn't make you guys freak out too badly. But for now, remember, it's a beautiful world out there, but encrypt your files.
The new Lamborghini, yeah, the new Lamborghini, come on now. Lamborghini, yeah, Lamborghini, ooh, Lamborghini, whoa, Lamborghini. There's only one way to go, there's only one way it shows, yeah, like a rocket to the moon, like a falcon in the sky, she goes up, 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 woo. Bitcoin's going up, come sing it, yeah, Bitcoin's going up. My Bitcoin's going up, sing it, yeah, Bitcoin's going up, up. My Bitcoin's going up, up, I swear every time I check the price, see that Bitcoin's going up, yeah, every time I check the price, my Bitcoin's going up, my Bitcoin's going up, Bitcoin's going up, every time I check the price, I say my Bitcoin's going up, woo, every time I check the price, I say Bitcoin's going, well every time I check the price, Bitcoin's going up, every time I check the price, my Bitcoin to the sky.